Welcome to this session of Physical Academy tutorial on lease versus borrow and buy decisions. In this lecture, I will examine operating lease and borrow and buy decisions. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, thank you for being part of this channel. What is a lease? A lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. A contract or part of a contract that conveys the right to use the underlying asset for a period of time in exchange for consideration. So, there are two parties to lease. Parties to lease. We have the lessor. The lessor is the entity that provides the right to use an asset in exchange received consideration. So that means the lessor receives consideration for the rights provided by him to the lessee to make use of the underlying asset. Number two, we have the lessee. The lessee is the entity that obtains the right to use an asset in transfer, that is, and transfer consideration. Types of lease. In accordance with IAS 17, which has now been superseded by IFRS 16, we have two types of lease. One, finance lease, and operating lease. IFRS 16 is not interested in the classification of leasing to finance and operating lease in the books, in the books of the lessee, but in the books of the lessor, that classification still holds or still apply. That means we still have the classification of leasing to finance and operating lease in the book of the lessor in accordance with IFRS 16. But in IFRS 16, this classification is no longer applicable in the book of the lessee. So what do we mean by finance lease? Finance lease is a long-term finance lease. A long-term, non-cancelable lease agreement. A long-term, non-cancelable lease agreement in which the risk, reward, or benefit of ownership is transferred to the lessee. The risk, reward, or benefit of ownership is transferred to the lessee. That means the lessee is the one responsible for the insurance and maintenance of the lease asset. That is for the finance lease. So, a finance lease is a balance sheet event. Being a balance sheet event, it means it will be recorded as a tangible non-current asset in the statement of financial position, and the lease obligation recorded as liabilities. So it's a balance sheet event. So it will appear in balance sheet. So in finance lease, the amount that will be expensed is the finance charge, that is the finance cost, that is lease interest, is what will be expensed in the statement of profit or loss of the lessee. The lease interest will be expensed in the case of the finance lease. The fair value of the finance lease is approximately equal the cost price of the asset. The fair value and the cost price of the asset will be close if they are not exactly the same. That is for the finance lease. The lease period will be approximately equal to the useful economic life of the lease asset. That is for the finance lease. That means the lease period will be the same or close. If not exactly the same, they will be closed. So any lease that meets those features I've identified or I've stated will be categorized as finance lease. The second type of lease I will examine is operating lease. An operating lease is a short-term operating lease. Operating lease is a short-term, non-cancelable lease agreement. A short-term cancelable, that is, it can be cancelled. It is finance lease that is not cancelable. So, operating lease is a short-term cancelable lease agreement in which the risk, reward, or benefits of ownership remains with the lessor. The risk, reward, or benefits of ownership remains with the lessor. That means the lessor is the one responsible for the insurance and maintenance of the lease assets, not the lessee. The lessor is the one that will insure it. The lessor will continue maintaining the asset. That is for the operating lease. Operating lease is a non-balance sheet event. It will not be recorded as an asset in the statement of financial position. The lease renter, in the case of operating lease, will be expensed in the statement of profit or loss. Remember, in the case of finance lease, it's finance charge, that is the finance cost, the lease interest, that will be expensed. But in the case of operating lease, it is the renter, the lease renter, that will be expensed in the statement of profit or loss. So it doesn't appear as an asset in the statement of financial position. The only thing that will appear as a liability is the renter that have not been paid. And where it is paid in advance, you have it as current assets. Apart from that, the lease renter will be expensed in the statement of profit or loss in the case of an operating lease. Please bear that in mind. So, now, for lease and borrow and buy decision, there are two stages involved. Stages involving lease and borrow and buy decisions. Number one stage is acquisition stage. Acquisition phase of the project. This phase of the project involves the calculation of the net present value of the project. You want to assess the viability or otherwise of the project. So, if you compute the NPV of the project, if the NPV is positive, that means the project is viable and it's worth investing in. So, the entity can go ahead investing in the project where the NPV from the project is positive. At this phase of the project involves the assessment of the viability or otherwise of the project by computing the net present value from the project. What are the relevant cash flows? Relevant cash flows associated with the acquisition phase of the project. Number one, we have the purchase cost of the assets. Purchase cost of the asset. Purchase cost of the asset. Number two is expected benefits and cost from the project. Expected benefits and cost from the project. From the project. Then you may also have the working capital. You've already knew how each of these items are treated based on my previous lecture on the capital investment decision or investment appraisal. the working capital, then the residual value of the asset. Residual value of the asset is another cash flow. Tax payments on annual cash profit. Tax payments on annual cash profit. Tax payments on annual cash profit. Then we also have tax relief on capital allowance. Tax relief on capital allowance. So we discount these cash flows using after tax cost of capital. Discount the cash flows using the after tax cost of capital. And it is when the NPV is positive that you can proceed to financing decision or financing the second phase. So the second phase is financing phase. Financing phase of the project. I've told you, you must have undergone the investment phase, acquisition phase, and calculate the NPV. And if the NPV is positive, it is then that you can proceed to this. Where the NPV is negative, you don't need the financing phase of the project. So the financing phase of the project we are going to examine in this lecture will be categorized into two. Number one is leasing. And the second one is borrow and buy decision. Borrow and buy. So these are the two financing method of finance we are going to examine in this project, in this lecture. So we are starting with leasing. Leasing. Remember the type of lease we are examining in this lecture is operating lease. Operating lease. Finance lease will be covered in my next video. So, what are the relevant cash flows? Relevant cash flows associated with operating lease. Number one, I've told you that the renter will be expensing the statement of profit or loss. If the lease rental will be expensed, therefore, the number one cash flows to be considered will be annual lease rental. Annual lease rental. Annual lease rental. So that will be cash flows. Since the renter will be expensing the statement of profit or loss, that means since it is charged as an expenses, it will reduce the amount to be paid. It will reduce the amount of tax to be paid. Therefore, tax relief or tax savings on lease rental is another cash flows. Tax relief or tax savings associated with the lease rental. These are the two cash flows associated with the lease option. That is, in the case of what? An operating lease. Remember, the method of lease we are examining in this lecture is operating lease. So, the second method of finance we will examine is borrow and buy decision. You borrow money, then you acquire the asset outrightly. You borrow money to acquire the asset outrightly. So that is borrow and buy. Borrow and buy decision. So what are the relevant cash flows associated with this option? Relevant cash flows associated with borrows and buy decision. The number one cash flows is the purchase price. purchase price. You know, the purchase price of the asset is the amount you will borrow. That is amount borrowed. That is, you will need to borrow the purchase price of the asset. That will be the number one, cash flows. Number two, proceeds from disposal of the asset. Proceeds from disposal is another cash flow that may associate with this option. Then number three, we have tax savings. Tax savings on capital allowance. Capital allowance. Remember, capital allowance can also be called tax allowable depreciation. Tax allowable depreciation. These are the relevant cash flows associated with borrow and buy decision. For financing decision, that is for leasing, and then for borrow and buy decision. So discount the cash flows using the after tax cost of borrowing. We use the after tax cost of borrowing to discount the cash flows associated with leasing and borrow and buy decision. Now, let's take a question as work example. Keep watching. This question is obtained from Workout Financial Management or Workout SFM by Ade Omoleiwa. Today is 1st of September 2023. TL is a company based in Nigeria. The company has adopted the International Financial Reporting Standards. TL is currently preparing a bid for a government contract to operate a train service on a new high-speed rail link between Abuja and Lagos. The investment appraisal of the project has been completed and shows that the project is financially beneficial. The focus of attention has now shifted to considering how best to finance the initial investment required in the new rolling stock. That is, locomotives and carriages that is needed to run on the line. The rail link will be operated by TL for a period of 10 years, commencing on 1st of January 2024. The new rolling stock required would cost 500 million naira if bought outright. Assume that there is an active market in second-hand rolling, and it is estimated that the rolling stock could be sold at the end of the 10-year period for 220 million naira. The following two alternative financial approaches are being considered. Bank borrowing from its primary bank for a 10-year term together with outright purchase of the rolling stock. A 10-year operating lease provided by the supplier of the rolling stock. Bank borrowing and outright purchase. TL will buy the new rolling stock on 1st of January 2024. TL can borrow from its primary bank at a 2.5% credit margin above the bank published base rate. The bank's base rate is currently set at 3.5%, but can be expected to change in line with changes in the market interest rates. Maintenance costs are expected to be of the order of 15 million naira per year if TL purchases the rolling stock outright. We have operating lease. An initial upfront payment of 58 million naira will be payable at the start of the lease on 1st of January 2024. 10 further lease payments of 58 million naira. Each will be payable on 31st of December in each year, starting on 31st December 2024. The lessor retains responsibility for maintaining the rolling stock throughout the period of the lease and has included the cost of maintenance service within the lease payment. Additional information. TS financial year runs from 1st of January to 31st of December. TL pays corporation tax at a rate of 33.1/3%, payable annually at the end of the year following that, in which the tax charge or tax savings arises. 100% tax depreciation allowances are available at the time of acquiring an eligible asset such as rolling stock. Lease payments made by TL would be allowable for tax when they are required. A. Evaluate using discounted cash flows approach as at 1st of January 2024, whether it will be cheaper for TL to buy and borrow or enter into operating lease for the rolling stock. Solution. The name of the entity is TL. And I've told you that whenever you are given a question, the starting point is the investment decision. You want to evaluate whether the investment is financially worthwhile. In the beginning of the question, you were told that the investment appraisal of the project had been completed, and it was confirmed that it is financially beneficial to replace the machine at this point. And since it has been concluded, that means the project is viable. Since it is viable, so you don't need to undertake the investment phase of the project. So what you need next is the financing decision. Remember, two methods of finance are being proposed for the project. So we want to start with operating lease as the first method of finance. Operating lease. I've told you that the relevant cash flows are annual lease payments or lease rental and tax savings on the lease rental. Those are the cash flows associated with the operating lease. Now, let's go through the information about this. You have operating lease. An initial upfront payment of 58 million will be payable at the start of the lease on 1st of January 2024. So at the start of the lease, upfront payment, there will be an upfront payment of 58 million. So we have items. So we have year. We have cash flows in million naira. So now in year one, we have initial payment. Initial payments. Since the initial payments of 58 million were made at the beginning of year one, so that means it will be used in year zero. Remember, I've told you, if you have watched my earlier video on timing of cash flows, I've told you that the cash flows occurring at the beginning of the year will be used in the immediate preceding year. And if it occurs at the end of the year, it will be used in the same year. So since it is at the beginning of year one, then it will be used in the preceding year to year one, which is year zero. So that is why we have that cash flows used in year zero. Then you will have tax savings. Tax savings on initial payment. Tax savings. Now, let's go through the information about tax. But before that, Let's finish if there are other information to use. Then we are seeing on the information of operating lease. 10 further lease payments of 58 million each will be payable on 31st December in each year. So, starting on 31st December 2024. So, another lease payments will be paid every year, and that amounted to 58 million as well. And that is payable at the year end. So, subsequent payment. Since it is payable at the year end, you use it in the same year. So the period involved is 10 years. So you have year 1 to 10. We don't know which period the tax savings relates to. So since we have not read the information about tax, that is why I'm leaving that. This subsequent payment also will also have its own tax savings. Tax savings on subsequent payment. Tax savings on subsequent payment. So now let's continue that note. You were told the lessor retains responsibility for maintaining the rolling stock throughout the period of the lease and has included the cost of maintenance service within the lease payments. Additional information. TF financial year runs from January to 31st December. TF pays corporation tax at a rate of 33.1/3%. So tax rate, that is 33.1/3%. Convert this to fraction. 3 times 33, that is 99 plus 1, that is 100/3%. Convert the percentage to fraction, it will be 100/3 times 100. No percentage made per 100, so it will be 100/300. If 0 cancels zeros, so you are left with 1/3. So that is the tax rate. So the tax rate is 1/3. Now, and you were told tax payable annually at the end of the year following that in which the tax charge or tax savings arises. Following year that follows it. So that means there is 1 year delay in payment of tax. Since the tax is payable in the year that follows, the year in which the tax charge or tax savings arises. So now, the tax savings on this now will be, since it occurs in year 0, the year that follows that, these payments will not be recorded in the financial statement in year 0, but will be recorded in year 1. So that means it will be saved in year 2. Since this will not, it will have been year 1, but this will not be recorded in year 0. There is no financial statement prepared for year 0. So that is why that payments will not be recorded in the account in year 0. It will be recorded at the end of the year 1. So the tax savings, that is the tax relief on the initial payments, will be saved in year 2, not year 1, but year 2. So that is why we have the tax rate we have calculated is 1/3 times 58 million. That gives us 19.33. Let's just say 19. So that is tax savings. Then this one, since there is 1 year delay, it will be for year 2 to 11. That is the one saved in year 1. The one for year 1 will be for year 2. The one for year 2 will be for year 3. The one for year 10 will be for year 11. That is why you have year 2 to 11. Since there is 1 year delay in tax. So, and tax saved will be 1/3 of this, which will still be 19 million. So, what is the discount factor to use? Back to the question. TIE will buy the new rolling stock on 1st of January 2024. TIE can borrow from its primary bank at 2.5% credit margin above the bank published base rate. 2.5% above the published base rate. That means you will add 2.5% to the base rate. The bank base rate is currently set at 3.5%. So the rate now, the discount factor, the pre-tax cost of capital will be pre-tax. The base rate is 3.5%, and it was 2.5% above the base rate. So that will be 6%. So your post-tax cost of capital now, post-tax, will be 6% into 1 minus tax rate. And the tax rate from our calculation is 1/3. So if you take your calculator, 1 divided by 3, 1 divided by 3, it gives us 0.3333. Subtract it from 1. It gives us 0.6666 multiplied by 6. There you have 4%. So the discount factor is 4%. Now, we want to use 4% to discount our cash flows. So we have cumulative discount factor at 4%. Then the present value of that in millions. Year 0 is always 1. So the present value will still be 58 million. Then year 2, since it is for only year 2 you want to calculate, that means you make use of the compound interest formula. And the compound interest formula is 1 plus r raised to power minus n. So for year 2 alone, r is 4%, our n is 2. So 1.04, we have 0.925. 0.925. Remember, we said the cash flows will be discounted using an after-tax cost of borrowings. So that is why we are using the cost of borrowing. 19 times 0.925. That is approximately equal to 18. 18. Then this is for year 1 to 10. Since these were grouped, year 1 to 10, you make use of the additive formula 1 plus r raised to power minus n over r. So n is 10, while r is 4%. So 1.04 raised to power minus 10. Subtract that from 1 divided by 0.04. So you have 8.111. 8.111. 58 times 8.111. That gives us 470. Approximately 470. Then year 2 to 11. There is no way you can calculate year 2 to 11. What you first calculate is year 1 to 11, taking n to be 11. So if n is 11, 1 minus 1.04, if r is 4%, is to power minus 11 over 0.04. So if you evaluate that, 1.04 raised to power minus 11, subtract that from 1 divided by 0.04. So that gives us 8.760. 8.760. This is for year 1 to 11. But what we need is not for year 1 to 11, but year 2 to 11. Remember, year 2 to 11, 1 is not part of it. 1 is not part of year 2 to 11. Since 1 is not part of it, that means you calculate for year 1 first. Year 1 alone using the compound interest formula, raised to power minus n. So, which is 1.04 raised to power minus 1 divided by 0.04. Year 1 alone will be 0.961. 0.961. If you subtract this, if you subtract it from this, No, this is for year 1 alone. So you want to take it from year 1 to 11 in order to get year 2 to 11. 8.760 minus 0.961 equals to 7.799. So for year 2 to 11 is 7.799. Better still, remember 1/3 of 58 million. Let me confirm that. 1/3 of 58 million. That is 19.33. Let me take it to 2 places of decimal. So same for this one. So the present value of this 19.33 times 7.799. That gives us 150.75. 150.75. Let me recalculate this. 19.33 times 0.925. That gives us 17.88. 17.88. So the PV will be the total of everything. 150.75 minus 470 plus 17.88 minus 58. That gives us minus 359. 359. Let me reconfirm that. 19.33 times 7.799. That gives us 150.75, yes. So 150.75 minus 470 plus 17.88 minus 58 minus 359. So we have 359 million. So that is the present value of operating lease option or lease finance. Then the second method of finance is bank borrowings and outright purchase. Borrowing and purchase option. So what will be the cash flows of this option? So I've told you the cash flows must comprise of initial outlay. Let's have year. So borrow and buy. And buy. We have items. We have year. Then we have cash flows. The cash flows is in million naira. So I've told you the first item could be initial outlay. Initial outlay, which will be treated as an outflow in year 0. The rail link will be operated by TL for a period of 10 years. So we have 10 years period. Commencing on 1st of January 2024, the new rolling stock required will cost 500 million if bought outright. If it is acquired outrightly, the cost of acquisition will be 500 million naira. And that will be treated as an outflow in year 0. 500 million. Now, back to the question. So you were told Assume that there is an active market in second-hand rolling, and it is estimated that the rolling stock will be sold at the end of the 10-year period for 220 million. This 220 million will be treated as an inflow at the end of the project life. The following two alternatives financing approaches are being considered. Now that you have written the outlay, I've told you the outlay will be treated as an outflow in year 0. Then the scrap value will be treated as an inflow at the end of the project life. You were told TF financial year runs from January to December 31st. TF pays a corporation tax at the rate of 33.1/3% payable annually at the end of the year following that, in which the tax charge or tax savings arises. So tax is a year delay. So following year, that means the tax for this year will be paid the following year. 100% tax depreciation allowance are available at the time of acquisition, or at the time of acquiring an eligible asset, such as rolling stock. 100% tax depreciation allowances, if it is available at the time of acquisition. No, the time of acquisition, you have the outlay to be 500 million. If the outlay is 500 million, so there will be capital allowance. If it is 100%, 100% of 500 million will still be 500 million. So tax savings now, savings on capital allowance, on tax savable depreciation or on capital allowance. No, the tax rate is 1/3 as calculated earlier times 500 million. 500 million. 1/3 of 500 million. The tax savings is 166.67. 166.67. That is tax savings, tax relief on capital allowance. So which will be treated as an inflows. No, in the year of acquisition. So this happens in the year of acquisition, which is in year 1. No, we said taxes will be payable the following year. Since it happens in year 1, that means it will be saved in year 2. Since it is a year delay, there is a year delay in payment of tax. So that means since it happens in the year of acquisition, the first year of the project, there is no way you will record the project in year 0 since you are not preparing the financial statements in year 0. So since you are not preparing financial statements in year 0, so the first year the financial statement will be prepared is year 1. We said the tax due in year 1 will be paid in year 2. So that is why we are treating that tax savings in year 2. Now back to the question. Now you were told that lease payments made by TF will be liable for tax when they are incurred. So we are not on lease payment for now. TF will buy the new rolling stock on 1st of January 2024. You know the formula here is about bank borrowing and outright purchase. TF can borrow from its primary bank at 2.5%, and this has been used to calculate the discount rate, and we've gotten the post-tax cost of capital to be 4%. Credit margin above the bank published base rate. The bank base rate is currently set at 3.5%, but can be expected to change in line with the changes in market interest rates. All these have been used earlier in calculating the discount rate. So you were told maintenance costs are expected to be of the order of 15 million per year if TF purchases the rolling stock outright. Okay, we have the maintenance costs in connection with outright purchase of 15 million. So we have maintenance costs, 15 million, and that will be treated as an outflow because maintenance costs will be expensed in the statement of profit or loss, and the period covered is year 1 to 10. Then we also have tax savings on maintenance cost. No, the tax rate is 1/3. 1/3 of 15 million. That is 5 million. If there is a year delay in payment of tax, it means since the period covered by the maintenance cost is year 1 to 10, then the tax for year 1 will be due for payment or receipt in year 2. The one for year 2 will be used in year 3. The one for year 3 will be used in year 4. The one for year 10 will be used in year 11. That means since that of year 1 will be used in year 2, so you have year 2. So the one for year 10 will be used in year 11. So we have year 2 to year 11. So we have tax saving. So now let's continue that note. So we have each year purchases the rolling stock outright. So the next information is about the operating lease. We have the scrap value of 220 million, which we said will be treated as an inflow at the end of the project life. So the scrap value inflows, and that amounted to 220 million. At the end of the project life, which is year 10, we have that as an inflows. Then, since the whole of the outlay were used in computing the capital allowance, based on the information we have, that 100% tax depreciation allowances are available at the time of acquisition, because we calculate tax depreciation on the whole 500 million. Remember, the depreciation, that is capital allowance, will have been cost minus residual value, but the residual value was not subtracted. Therefore, the tax that will be paid on this residual value will need to be subtracted, since tax were earlier calculated on the 500 million instead of using 500 million minus residual value, cost minus residual value. No, depreciation is cost minus residual value, but we didn't subtract residual value because you were to calculate tax depreciation on the whole cost of acquisition based on the information you have in the notes. So as a result of that, now we have tax payment on scrap value. Tax payment on scrap value, which is 1/3 of 220 million. 1/3 of 220 million. So that will be used in year 11. No, the tax for year 10 will be due for payment or receipt in year 11. So what is 1/3 of 220 million? That gives us 73.33. 73.33. So what is the discount factor? At 4% cost of capital, and this has been calculated earlier. For year 0 is always 1. The present value, 500 times 1, that will be 500 million. Then for year 2, we got 0.925 the other time. What is the present value of that? 166.67 times 0.925. That gives us 154.17. 154.17. For year 1 to 10, we got the cumulative discount factor to be 8.111. 8.111. For year 2 to 11, we got year 2 to 11, we got 7.799. 7.799. That was the result of thing for year 2 to 11. For year 10 now, year 10 will be 1.04. 1.04 raised to power minus 10. That gives us 0.676. 0.676. For the year 11, for the 11th year, 1.04 raised to power minus 11. That gives us 0.650. So what is the present value? Minus 15 times 8.111. That gives us minus 121.67. 121.67. 5 times 7.799. That gives us 38.39.00. 220 times 0.676. That gives us 148.72. Then 73.33 times 0.650. That gives us 47.66. What is the present value of that? 47.66 plus, this is, it will result in payment outflows. 47 minus 47.66 plus 148.72 plus 39 minus 121.67 plus 154.17 minus 500. We have 327 negative 327. So we have 327 million. So now let's compare the 327 million for borrow and buy option with what we have for leasing. So for leasing option, you have 359 million. So it means it is cheaper to borrow and buy. To borrow the money from the bank and acquire the asset outrightly. So you recommend borrow and buy option. So this marks the end of the solution to this question. In my next video, I will examine the finance lease versus borrow and buy option. Please drop the love emoji, like the video, also share it with others. Thanks for watching ZICA.